All right, hello everybody. This is Patrick Zielbauer. It is 3:30 on Tuesday, June 12th. Thanks everybody for coming to the event today. I want to go through some risk stuff and then we're going to get right into it. I want to focus a little bit on the actual trading platform while we still have a live data feed until 4 p.m. Central. And then we're going to come back and forth with some of the slides and go through some things. Please do feel free to ask questions throughout if there's anything that we can clarify for you. I'm going to try to cover a lot in a short period of time here. So please feel free to ask if there's something that's on your mind. All right, so let me just start this real quick. And I have to switch these around. All right, welcome, Infinity Active Trader Bootcamp. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. One of the great things about being an NFA member is that we are registered and we have the ability to give personalized advice based on someone's situation. So if you ever want to discuss risk or talk about day trade margin or whether this whole thing is appropriate for you or otherwise, please do feel free to have a conversation with me about that. That's why we're here. There's a lot of places that you may inquire for advice that cannot provide specific advice to you, like people in the educational community, people who are not registered with the regulators. We here at Infinity can. Most of the people that work in our outfit are NFA members, and we are happy to discuss with you on a more personal level trading and how we can fit into the picture for you, and whether or not this type of trading is something that you should pursue. So please don't ever be afraid to have that conversation with us. We're happy to. All right. What I want to do first is just say thank you to everybody who's here. Most of the people that are in the event today are already live clients. There's a couple people who are very close to becoming live clients. I just want to do a quick about us so that some of you who have just recently been referred to us without knowing all that much about us and are still getting started, we appreciate that very much. We are what's called an IIB, or an independent introducing broker, established in 1995, so we've been around a long time. This business has contracted a lot through the aftermath of the market crash, largely due to the regulatory environment, which has gotten much tougher to operate in. And as a result, we've seen a lot of consolidation in our industry. And what that's left is it's left Infinity competing with some of these very large companies that can't provide the kind of individualized service or flexibility that we can. So we actually have relished the opportunity to grow stronger through what has been considered a relatively tough time in the brokerage business. We're very proud of that, and we're glad you're with us. All right, the company is headquartered in Chicago. We have several clearing relationships. We are FCM owned and operated. We will discuss in a minute what exactly that means. We have one focus, and that is futures. We really don't do anything else. We used to do some FX stuff. That's really no longer a part of our world. Our flagship product is Infinity AT, which is our order execution platform, and Sierra Charts, which is our charting software. So we'll touch on aspects of each of these things here in a bit, but we do want to say thank you for being a client. We greatly value your business, and thanks for taking the time to watch an event like this that is geared towards people who are in the onboarding process. All right, so one thing I really would like to get across is how important I believe it is to be using an FCM owned and operated brokerage company. Okay, FCM owned and operated means that the futures commission merchant who's holding the funds owns the technology you're executing with. In this case, also the data feed. And I'll explain how we're different. So if you look at this little cheesy graph that I made, you'll see at the top, this is a lot of the companies that are sort of boutique-y, sort of like Infinity, there's not a lot of them left, represent what you see at the top of this little picture. You have a big clearing firm sitting on top of everything, and then all these different services related to your account are outsourced. So the statements are done by some third party, the data is brought in by a third party, the order routing is done by a third party, and then the trading platform that you're executing your orders on is done by a third party. So in some cases, at the very least, you have 5 different entities involved in your order and your ability to trade and maintain your connectivity and so forth. And that's just the ones that you might see or know the names of. There might be many more behind the scenes. And one of the things that's really troublesome about this model is that in our experience, because we in the past have had some of these sorts of setups, when something is awry, if there's an issue, no one knows whose problem it is. It's just like any other business that you might deal with. Instead of one point of contact, you have 4 or 5 that you have to deal with, and they're all just pointing their finger at each other. We've been through this, and that's one of the reasons why we really enjoy our current situation, which is the bottom graph that you see at the bottom. All right, Transact and Infinity are owned by the same private individuals. Transact provides the statements. They have their own data, their own routing, and their own trading platform. And it just makes it very, very easy for us to do support if there's a problem. All right, so no one likes to think worst case all the time, but in our business, which is largely the risk management business, you really do have to think about all aspects of trading, including the stuff that's not fun to talk about, like outages and connectivity issues and the internet and all the associated things that come with operating in that medium. And it really does. We do believe that this ability to maintain everything in-house translates to a better experience for our clients, because we can give more accurate information, we can fix things faster, we can tell people that we understand what's happening, and we believe this goes a long way. So I believe this to be a very important aspect of our business. And what you generally find in the futures business is that the only companies who have a model that resembles ours are the really, really big shops like TradeStation and Thinkorswim and a few others, where they have their own tech, but they severely lack in areas that are important to futures traders, like commissions or margin requirements, the reliability of the platform. Thinkorswim is a great example of a company that operates under the TD Ameritrade umbrella, which is has seemingly unlimited resources, but for some reason they just don't do as well on the future side. And we end up with a lot of people who are equity option traders who come from TOS. Well, they have this FCM owned and operated model, but they still struggle. So Infinity's right in the middle. We have an FCM owned and operated program, but we're still kind of a boutique-y firm that gives people the flexibility that that they have grown to or they have become accustomed to. So we believe that to be an important thing. All right, now there's 3 ways that a new customer can get the most out of an account with Infinity. One of them is to understand the DOM, or the depth of market screen, like the price ladder that you trade from. One of them is to understand the charting software, Sierra, and the other is to understand our risk management system. So we're going to talk about each of these things here, a little bit of each. All right, I do want to talk about the risk system, but before we go here, because this is really important, I do want to show a little bit of the trading platform first, because the market's going to close in 22 minutes, and I don't want to miss out on being able to see at least a couple of examples of some live feeds. All right, so I'm going to minimize the PowerPoint. In the background, I have Sierra up, and I'll explain what we're looking at here in a little bit. I'll mention this again later as well, but if anybody wants a copy of the file that I've got here, I'll be happy to send that out to anybody who's interested as well. Okay, so bear with me just 1 second. Okay. All right, so for those of you who are unfamiliar, this is what our platform looks like. So this window here is called the scoreboard. I just want to make sure everybody can see that. Okay, so this window here is called the scoreboard, all right? And you'll hear that term in a lot of our videos. And then this window here is the DOM. All right, so the way to bring up the DOM is to locate the symbol in this list and then push the little blue arrow under the D column that corresponds with the symbol you want. So for example, if I want to look at the September E-mini S&P, I can locate that symbol in this list. It's going to be, your symbols that you have available are in this drop-down menu up here. So if you want to add a symbol, you just locate it. Like let's say that I want to look at the September yen contract. Or actually, I guess we're still in the June yen. You could select 6J, M8, push the little blue plus sign, and then that's going to create a line item down here for the contract. Now, if it looks blank for a minute, that's okay. What happens is you won't see the data come through until an actual trade executes at the exchange. It's 20 minutes until the close. There's probably not a lot going on in the yen right now, so we might not see anything here for a couple of minutes. That's okay, don't panic if you see that. But that's how you add a contract to your list. All right, so if I want to bring up, see, there it comes. Okay, so there was just a trade done, so now the yen, is visible. So if I want to launch the DOM for the E-mini S&P, I just push the blue arrow under the D column like this, and that brings up the DOM for the E-mini S&P. Okay, so this is what this would look like. Earlier, as you saw a moment ago, I had the Russell up like this. You can have as many of these windows open as you want. All right, if you've got a couple of screens, great, you can put them all over the place. If you only have one, that's okay too. You just have to find a way to make everything visible on the screen or accessible quickly if you need it. I'll give you some examples about how you might do that here in a moment. All right, one thing that just from a basic order entry and just the view that you're seeing here, one thing you may notice is this S&P dome, it looks fatter, like wider than the Russell. All right, so the couple things you can do to reduce the screen resources or real estate used by each dome is you can put your cursor right in between these columns at the top where one meets the other. You'll see the cursor turns into this little vertical arrow thing, and you can just grab it and squish it to the left a little bit. And it's kind of annoying because you have to do this for each market. Each one's different, but you could do it for the markets you focus on the most, and you can end up with a screen a little bit more narrow. This last column, I usually hide this like this. So you can actually take the whole window and make it smaller. So usually when I'm looking at the dome, it looks something like this. And if you do that on the markets that you follow most, if you've got another screen where you can put your domes, you might be able to fit, a couple extra ones just by doing that on each one of the markets you trade the most. All right. So again, you just put your cursor up there. You could squish these to be a little bit more narrow. All right. Now, when it comes to order entry, the basic premise behind our platform is order placement, cancellation, and modification. All right, if you know how to do those things, you really know how to do what the majority of the people who trade with us are doing. You can also do some really fun stuff with bracketing. We'll talk a little bit about that. But one thing I definitely want to mention is this little quick click option right here. This makes your order entry single click. So if I don't have this checked and I put a 1 in the quantity and I try to buy one E-mini here at 27.89, so I left click in the blue column, nothing happens. If I double click, I'm going to get the response. All right, now if I want to cancel that, I can double right click my mouse on the order in the limit or the stop column. I try to teach people to use the program with quick click enabled because double clicking on trading platforms just in general is a bad idea, at least if you ask me. So I would encourage you to try to use the program with quick click on so that you know how to place orders with one click on the grid. These buttons here on the left, like the buy market, sell market, flatten, all that stuff, these are going to be single click no matter what, whether you have quick click checked or otherwise. All right, so quick click is checked. I can come down here into the blue column. If I want to buy one at 89, I just left click. Now I have an order at 27.89. If I want to cancel it, I could just right click my mouse right on the one like that. Okay, so left click to place the order. Okay, right click to cancel. You can also hit cancel all on the left hand side, which will cancel any orders you have working in that particular market. So again, left click to place the order like this, right click to cancel, or you can hit cancel all. All right, cancel all does not close trades. It only cancels working limit or stop orders. So if you have a position on and you hit cancel, nothing's going to happen except any orders you have will be canceled. You will not actually close your position. The flatten button here, you can actually click to close trades, and we'll demonstrate how that behaves here in just a moment. All right. Sell orders are the same thing. So if you want to go short or you want to place a manual sell limit order somewhere as a profit target onto a long position, or you just want to be short from somewhere above the market, just left click above the market on the sell side, right click to cancel. Same behavior. Or you can hit cancel all. Okay, modification. To modify an order, you don't actually hold the mouse button down on this order. You just left click your mouse. So right click is cancel. Remember, right click to cancel. So place it, cancel it with a right click. But if you want to modify it, you hold your mouse over the quantity, left click. You're going to see the cursor turns into a little hand, and then you just left click again to drop it. So again, you don't actually hold the mouse button down. You just left click on the order, stay in the column that you're in. All right, and then move your mouse and left click again to modify. That's modification. So, the basic tenets of the application we've already covered in 3 minutes. Place the order, cancel the order, or place the order and modify the order. All right, then I just canceled it again. All right, so are there any questions, just real basic questions on just the order placement part of this? It should feel really easy. The program is very light. It uses almost no system resources. For those of you who are coming from using TradeStation or Thinkorswim or something like that, one option for you if you want to simplify your life is to just use our dome. You don't have to use our charts at all. If you want to minimize the charts altogether and minimize the scoreboard, and you want only the part of our platform is like this thing right here, and all your other charts from Thinkorswim or whatever are all over the place, that's perfectly fine. This is how a lot of people use our program. Now, we love our charts. Most people don't pay for them because they're so, the threshold for making them free is so low. But please don't feel obligated, okay? You don't have to complicate your life with the charting if you don't want to. If you want to use them, we'll gladly train you on them, but they are optional. All right, so again, what we've generally found is that if we're talking to people who are at competing firms, one way to really lower the barrier to starting the account here is to remind people that the charting is not necessary. So if you just want a nice light execution platform, this could be it. All right, but I'm going to bring everything else up here so we can continue with the example. All right, now one thing that you may notice is that when you open a new dome, the quick click box is not checked. You can make that a default if you want. All right, the way to do that is to go to the properties button in the top right corner of the scoreboard, right up here. All right, and then check this option that says default quick click. Default quick click. Now, I would not mess with too much in this properties section. This application has lots of settings that we sort of put in place that are put in place for a reason. If you are unsure, I'm not going to go through every one of these because they really don't need to be messed with very much at all. But if you ever want a specific answer on something, come back to me personally or individually, and I'll talk you through it. But there are not a lot of situations where things in here should be adjusted. I would just leave it as is. There are some, less common situations where we may ask you to make a change to something in here, but for the most part, don't mess with it too much. Okay. But default quick click, we leave that unchecked by default because we don't want people inadvertently placing orders and they don't understand how to use the program. But you can always come here and check this, all right, which will make this box always checked when you launch a new dome. All right. This scoreboard window, a lot of people ask me, what do you use this window for? I mean, really, this window is just like your home screen. You can use it as a quote screen. The charts have their own quote screen, so some people don't even need this. They just minimize it. Don't close it, or the dome will also close. But you can leave this window minimized most of the time if you've got the domes up that you need. But you can easily bring it back. It's going to be visible at the bottom of your screen in your taskbar. All right. Another thing that is just really important to know is this little open book icon in the top left corner. This is an open order window that looks like this. So the open order window is important because if you put an order in, like let's say I wanted to buy an S&P at 27.85.75. So I put this order in. All right. Oh, you know what? Actually, I've got a setting on here where this isn't going to display. So this actually won't work for me. But what I'm going to explain to everybody here, and I'm sorry, this is not a great example, but this window is going to display working orders that you've got. And so what I would encourage you to do is if you are trading where you might have orders that where the market goes away and you sort of forget about it on the dome, keep that open order window open because it's a good place to remind yourself that you have something working. Most people do when they're done for the day or they're flat, they'll come and hit cancel all just to make sure that they didn't leave anything out there. But sometimes it's helpful to just have this window up here just in case you leave something out there and you forget about it. So again, you're not going to see it on my screen here, and I apologize for the lack of clarity, but generally speaking, keep this window up or at least check it from time to time to make sure that you haven't left something out there that is still working and you walk away and it gets filled while you're gone. All right, that usually doesn't end well. So the way to get to that window again is the little open book icon in the top left corner. There's also a completed trade log here, and right to the right of that, it looks like a little completed, little closed book icon. This is not like a P&L log, it's just a list of the fills. So there's not a lot of data here, but it is kind of nice to come here and just make sure you know how many buys and sells you did. And, for example, if you only trade one market and this says total buys 5 and total sells 4, well, that means you may have come into that day with a position, or you may be in a position because these numbers aren't matching. So it's just another thing that you can use to double check your work. All right, so open book icon is your open orders. Closed trades is the closed book icon. This is the window you can select markets from. There's something in here or something not in here that you want. Just email your rep, me. Most of you work with me here, and we can get it added for you. You can also send your requests for new contracts directly to support@transactfutures.com. A lot of you saw that in that ready to trade email that you get when you fund your account here. Okay, the reason why we give you that support email address is because it's monitored 24 hours a day from Sunday night until Friday's close. So, you send them a note, hey, support, can you please add, the Canadian dollar for a 5-lot maximum? They're going to do that at 2 in the morning, whereas obviously I'm not going to see it until I get into the office. So generally speaking, for removing and adding contracts or changing your limits, which we'll talk about here in a bit, the best way to get that stuff done is to do it directly with the support desk. Okay. I'm going to demonstrate just one example of the simple bracket. I'm not going to go into the multi-brackets too much here. Maybe we'll get a chance to do one example. I'll bring up crude oil. It's kind of a fun one. We only have a few minutes left, though. Simple bracket is right here in the drop-down menu. So this is the default bracket option. There's also trailing stop, multi-bracket, multi-trailing. Again, there's some videos that cover some of these. I'm just going to go through a couple quick examples. Simple bracket just means one target, one stop in ticks. So a 10-tick target and a 10-tick stop is 2.5 points in the E-mini S&P. So if I put those values in and check auto and just buy one contract at the market, we're going to get filled. We got filled here at 92. And then this is our target, 2.5 points above the market, or 10 ticks above the market. And here's our stop, 10 ticks below the market. So this is essentially what you would call an OCO bracket. Okay, so when this gets filled, the other one's going to cancel itself. Right, that's what this what simple bracket means. Now, with some of the other markets, or really with any market, but we'll do it on crude here as an example. There's a property section that allows you to get to a section called set multiple exits, where you can actually do automatic scale out. So in this case here, I would probably never use a 4-tick target in crude, but if you were trying to do some really quick trades, you could do 1, 1, and 1. This means we're doing 3 contracts total, targets of 4, 8, and 12. All right, and then I would go to multi-bracket. And if you want your stop to move to break even or something after your first target is hit, you could do that. That's what this option is. And check auto, just like we did on the simple bracket. So we got a 3-lot trade. I'll just hit buy market. Okay, so we're long 3 crude, target 1, target 2, target 3. Here's our stop. Okay, 16 ticks away because that's what this stop is set to. And if the first target at 66.10 were filled, then the stop would go to break even plus 0 ticks. In other words, it would just go to break even. So scale outs are pretty cool in this program. For those of you who have a high probability of getting your first target and sometimes you can't get the other ones, you can also weight your first target more heavily. So an example of that would be, like, for example, let's just bring up gold here real quick. If we were doing a 3-lot trade, go to properties, multiple exits. Let's say I was doing 2 contracts in the first exit, 1 in the second, and I was doing 4 and 10 for the targets and ticks. So if I do another 3-lot trade with multi-bracket, I'll do that break even like this. Oops, I need to put a stop loss in, so it's giving me a warning. Do 15. So let's just go short 3 gold. Okay, so we're short 3 gold, but notice our first target is 2 contracts. Second target's 1 contract. The stop is for all 3. So this is what a short position looks like. Okay, the short position right here, -3. All right, long position +3. All right, this one's +1, it's 1 contract. All right, so the program will allow you to manage multiple strategies across multiple markets with relative simplicity. I would say that the most fragile aspect of the program with respect to functionality is probably the trailing stop function. So if I do trailing stop here, you've got these 3 variables you have to put in place. And the most important thing is your initial stop loss. Make sure that that's wide enough to make sense. Let's just do this at 15 for now. And then the trigger and distance really need to be set properly. So the trigger and distance can't be left at 0. All right, the trigger means that how many ticks you want to make before the stop starts to trail. Let's say in this case 5. And the distance is how far behind this level do you want the stop to trail by once it starts trailing. So the distance can't be a really small number. If you leave it at 0, you're either going to be stopped out immediately or your stop will be rejected because it's going to try to put a stop order right on top of where the market is and the exchange won't take it. So just in general, the distance number should be bigger than you may think. All right, if you're trading a market like crude or gold or the Dow that has like single or double digit bids or offers, make sure this number is wide enough to make sense. All right, so if I check auto and just let's buy one at the market here, we only got a couple more minutes of live data. Here's our entry price of 351. Here's our stop loss 15 ticks away. All right, this stop will not move until we get to 56 because that's 5 ticks and that's what our trigger is. So this stop will not move unless we were to make 5 ticks first. And at that point, it would trade 10 ticks behind this level and then move tick for tick with the market. So Bob, your question there about the trailing stops, if you're not seeing them regularly activated, 99% of the time it's a configuration issue. I would make sure that your trigger and distance numbers are big enough. And if you're sure that they are, then come back to me directly, more on a one-on-one basis, and we can figure out why they're not going in. But this is the way a trailing stop generally is set. It's just really important that the trigger and distance be valid. Otherwise, you're going to see rejections or failed to send orders and things like that. Now, another possibility, if it's a fast market, there's a lot of communication that has to be happening back and forth for trailing stops to function. The exchange doesn't care that you want this to be a trailing stop. So every single time the market is ticking up and your stop is moving, that is our platform saying, okay, cancel, replace, cancel, replace, cancel, replace, cancel, replace to a new price. There's a lot of talking that has to happen. If the network isn't great, if there's an internet connectivity problem or something like that, it can impact the performance of a trailing stop. All right, so that's why I call it the most fragile sort of way to manage orders, is because there's so much communication that has to be going back and forth to function properly. And if there's a network issue or some other issue, it can impact that. So we can work on that more on a one-on-one basis, especially if there are errors. There are some log files that are on your computer that we can request from you and you can share with us, and that will help us figure out why something might not be going in. But generally speaking, it's either a configuration problem or a network problem. There's not a lot of complexity to this order type, even though it might seem like there is. All right, so if I just wanted to bail on some of this, you can push the flatten button. All right, we got a few minutes before the market closes, so if I just wanted to say, you know what, let's just get the heck out, you can push flatten. One thing about the flatten button is that it sends a cancel all request to the exchange before it sends a market order. So it's a little slower than just hitting buy or sell market. Flatten is kind of neat because you don't have to think about whether to hit buy or sell. So if you're short and you accidentally hit sell, you're going to be more short. Right? If you're long and you accidentally hit buy, you're going to be more long. Flatten takes the guesswork out of it. You just push flatten, but that comes at a bit of a cost. And the cost is the platform is trying to make sure you don't get double filled on something. So it's going to cancel all first, and then right behind the cancel all, not waiting for the confirmation, but right behind it, it's going to be sending a market order. So it's just a tad slower than using the buy market, sell market buttons. So if you're concerned about slippage or you're trading fast markets, you may want to consider either modifying your limit order into the market to get a fill, or using buy market or sell market instead of using flatten. All right, particularly if it's like a very fast moving market, something to consider. All right, so that's just a quick run through on the trading platform. You're going to see a little flurry of activity here as everything closes for the day. So I'm just going to shut these domes down for now and move the scoreboard off onto the other screen. But I hope that seeing some of that demonstrated, even though I know we're moving pretty quickly, is helpful. We are recording this, and we will put it up on YouTube for everybody who wants to watch it as well. So please feel free, to watch the recording along with, your own platform to see if that will help you. All right, and of course, I'd welcome any specific questions, especially since you guys are taking the time to come to the event here today. All right, so let's go back to this slide here. I would like to talk about the risk system. This is, to me, one of the most important parts about maintaining the account here with Infinity. All right, there are two aspects to the risk system. Okay, one of them is how we monitor contract limits, like your position limits, and the other one is how we monitor your P&L. Basically, at what point are we going to cut you off or try to cut you off? All right, let's talk about the first one first. Okay, the contract limits. The contract limits represent unique net position limits per market. So you might want a limit of 5 contracts on the S&P, NASDAQ, and the Dow, but only 3 on gold and 2 on crude oil and 1 on soybeans or something like that. They vary from user to user. They can be different, as I just mentioned, from one market to the next, and they can be changed under normal circumstances with relatively short notice. And by relatively short notice, I mean 2 to 3 minutes-ish. Faster if you call it in. If you do it via email, give it a few minutes. But you'll get a reply from either us or our support desk letting you know that your request has been completed. Or if your request falls outside the bounds of our risk parameters, we might max out what we can and tell you what we did. So as an example, many people have heard the term $500 margin per contract, right? All right, that's very aggressive. That means if somebody has $20,000 in their account, if they really wanted to be able to trade 40 contracts of the indexes, they could do that. There's a lot of very obvious reasons why we don't recommend doing that, especially for someone who's just getting started. But let's say someone with $20,000 asked to trade 100 contracts. Okay, I know it sounds silly. Our risk people obviously would not let that happen, but they might max out the limit and then tell you what the limit is set to. Most people like to keep the limits relatively modest for a very good reason. Number one, it's a new platform. You don't know where you're doing yet. You might click the buy market button a few times by accident. Having some modest limits can help you prevent what is commonly referred to as a fat finger mistake. All right, where you accidentally had 10 in the quantity instead of 1. You had the money to do a 10 lot, so we set you up for a 10 lot, and you accidentally hit buy market and you got into a 10 lot instead of a 1 lot or a 2 lot. All right, that's a mistake that we'd like to prevent before it happens. One way to try to do that is for you to instruct us to keep your limits where you want them to be. So if you're only going to be trading 1 or 2 contracts, you may request, maximum maybe a 4, just so you have a little bit of freedom. But if your game plan is to trade 1 or 2, don't ask us for a limit of 25 if you have the margin to do it. All right, it just doesn't make sense, because the only time you're going to do it is if you are either don't know what's going on in your account, or you made a mistake and now you're trying to dig out of a big hole and you're probably going to dig a deeper one. So having modest limits on the account forces a customer to work within a reasonable framework that usually jives with their initial game plan. That's why it's such a valuable thing. Most companies will never take the time to explain how important this is. We believe it to be a really vital part of maintaining longevity of our accounts, instead of just maxing out the limits and saying good luck. All right, so think about what your limits are. If you don't know what they are, ask your rep in our office. We can tell you what they are. And if you need to make adjustments because of what we're talking about today, please feel free to request adjustments and we'll get it done. All right, does anybody have any questions about the contract limits? All right, these are per market, remember. So if you have a limit of 2 in the S&P and NASDAQ, that means you could be trading 2 S&Ps and 2 NASDAQs. Okay, not either or. You could even be trading them in the same direction. All right, so our system is going to let you do both markets. It's not like you have to be long one and short the other. Okay, you could trade 2 in the same direction. So any questions on the contract limits? Now's a good time. If you're a brand new client and you're just about to get your account funded or something like that, we're going to give you a mechanism once your funds arrive on how you can make these requests. Okay, if you're already a client, you should already know how to do it, but if you don't, just contact me and we'll instruct you. All right. Okay, the daily risk limit. The daily risk limit is a negative dollar amount. If equal to your open trade equity and cumulative P&L, will it trigger an attempted auto liquidation. So let's say your daily risk limit was $1,500 and you had a really awful morning and you're down $1,200 in the morning. And then it's the afternoon and you're in a trade and the trade is down 300. Okay, your open trade equity is minus 300, your cumulative P&L is minus 1,200, you are now down 1,500. Our system is going to see that, and provided that it's operating normally, which 9.5 times out of 10 it is, it's going to try to liquidate those positions at the market. All right, this originally was designed and still is implemented to protect the firm from people going negative in their accounts. So for example, there's a super fast market, someone's long the market, it's going down, they're not picking up the phone, we don't know what's going on, we can't let them go negative because then we have to try to collect a debit, which we don't want to do, and we need to protect that company. So we implemented this system at the clearing level with Transact. But you don't need to rely, you cannot and should not rely on it as a stop loss. It's a computer system, just like anything else. It can fail if our connection to the exchange fails or something like that. So the best way you can protect yourself is using a stop, because the stop loss is sitting on the exchange server. So even, God forbid, if we are having a problem with our connectivity, your stop order is still at the exchange and still can be filled, even if our entire network is down. All right, using a stop loss order is really the only way you as an individual customer can protect yourself. So you should always do it. But the risk system is a flexible system that we have that we normally start off at around 60% of the account's balance. So if you have $10,000 in the account, we will typically default it to $6,000. And if you want to lower it, you can. Most people are not going to want to risk 60% of their balance in a day. All right, if you tell me, look, Patrick, my personal risk limit is every day it's $650. Where should I put my risk limit? Maybe we put it at 1,000, maybe 1,200. We don't want it getting in the way. All right, what we don't want to do is the market runs down, taps the risk limit for 0.0001 seconds, and then runs back the other way. But by that time, our system's already blown you out of the position. All right, that's what we don't want to do. This should only have to happen if something is going wrong, like you accidentally had an order in and you forgot about it, or you are losing your mind and you're in positions and our system is stepping in, to try to liquidate you at a level that you at some point thought would be a good level to have, in terms of a circuit breaker. So that's what it is. All right. If you are not sure where your risk limit is, we email you, Transact emails you when a change is made. You can also see your risk limit in red letters on the login screen when you log into live mode. All right, so you'll know where it is, and you need to know where it is. All right, if you ever need to make adjustments, you can let us know, and we can make adjustments on the fly, just like we can with the contract limits. If you need some extra room and we need to expand it, that's okay. We can evaluate that on a case-by-case basis in real time. Just don't wait till, if your risk limit's $500 and you're down $498, okay, don't expect us to be able to change it in time. Okay, the market's moving quickly. Give us time to make adjustments if we have to, because sometimes we have to evaluate the situation to make sure it's appropriate. All right, does anybody have any questions on either the contract limits or the daily risk limits? I know these are not particularly sexy topics to discuss because they're all, it's all kind of has a negative connotation, but this is all about protection. It's about making sure that we understand how you understand how our system works, and it makes us feel good to know that you understand it, and it's all about protecting the account. That's the bottom line. All right, so if there's any questions, do feel free to ask, but I'll keep moving. The Infinity AT Dome, we've already talked about a few of these things. All I'll really say is that the system has almost no impact on your computer's resources. I took this little screenshot a while ago of the Trader.exe app on my computer using less memory than one tab of Google Chrome. And it's just an unbelievable program. It's not loaded with a lot of useless gadgetry. And again, it's FCM owned and operated. So the company holding your money, our parent company Transact, owns and can support it directly. All right, we believe this makes for a platform that can function in fast markets. Okay, so when you're using a big heavy program that's using up 10 times or 20 times or 100 times this amount of resources in a fast market with your chat rooms going and your other platforms cranking through data and everything's really pushing really hard, internet as a whole is stressed, that's where you're going to start to see reliability problems. And our program just tends to skip over a lot of those because it doesn't need as much. All right, so it's an important thing that's really hard to fit into an email or a spreadsheet about why we think people should trade with us. All right, this is a little screenshot of the Dome. We've kind of covered some of this already, but so I'm not going to spend any time here, but if you want to come back and look at the recording and look at this, you can. All right, so the charting side, Sierra is a professional grade program. It's got basically every study. It's free with a little bit of trading, 10 round turns every 30 days, and we waive the fee that we would otherwise charge, which is $20 or $19.95. So it's very inexpensive, and most people do not pay for the charting because of the low threshold to make it free. But again, it also is a very lightweight program. It's got profile, it's got bid-ask volume, it's got all kinds of custom alert conditions. It's basically it's endless. And I will show you a couple of examples of how I use the charting on a daily basis. And maybe it can inspire you to do some of the fun stuff that I think I've done with the charting. And for those of you who are unaware, I teach a class on the charts every Monday that covers either a specific aspect of the chart or like sometimes it's like a general walkthrough. Like the one on this past Monday, yesterday, was kind of an introductory to the charting program event, and it's already posted on YouTube, and I can get the link for anybody who wants it. All right, so we'll keep moving. All right, day-to-day management of the account. So know what your risk limit is and know how to access that open order window that we talked about. All right, if you hold positions through the close, understand overnight margin. Okay, try not to go on margin call. Keep the overnight desk number handy and make sure you have solid connectivity. Okay, everybody here should have the help desk number, a 24-hour desk number. If you don't have it, email me and I'll get it to you. Generally speaking, we would recommend you use a hardwired network rather than wireless networks if possible. Our experience is that people's expectations exceeds the technology they're utilizing when it comes to being able to work with a data feed like ours. Part of the reason why our data is so quick is that we use what's called a UDP feed. It's very fast, but it's also more subject to being affected negatively by packet loss, which is bits of data being lost as they're being transmitted wirelessly. And you're just more likely to see that with a wireless network. So it's not like using our program is not like checking your email or even like using your TOS platform or something, watching a YouTube video. We really do need a solid connection. We don't use a lot of the system resources on the computer, but the network connectivity is more important to us. All right. The first point here I mentioned, if everyone would just make a special note of that, if you hold positions overnight, or even if you don't, make sure you look at your statements every night, or we're trying to get them out earlier at night, so you're going to see them eventually come much earlier, but especially Friday night statements. So Friday night statement you can look at over the weekend, and if you inadvertently hold a position on Friday that you didn't know you had or something, you can get out of it Sunday night. All right, if you don't look at your statement on Friday and you held a position and you don't look at your statement until Monday and you're long over the weekend and the S&P opens 25 points lower on Monday morning, that is a situation that might have been able to be prevented had you known you were in the trade, and you could have addressed it at 5 o'clock Central Time on Sunday night. But by the time you look at everything's happened overnight. Now the S&P's $1,000 against you, and we have this big problem. So make sure you look at your statements. Be especially vigilant to look at your statements over the weekend. Okay, so that means for Friday's trading activity. So if there is something that you left out there, you can address it on Sunday's reopen instead of waiting till Monday. Okay, just a little tip. We've already talked about the dome pretty much, so we're going to skip this. Okay, so now I want to show a little bit about the charting program. So you can send an email to me for access to this. It's free. One thing we do with the charting events is we like to give people the files that we make during the webinars. And the reason why is that it's a good way to learn, because you have the actual software, you can watch the recording, you can import the files and work backwards off of them. One of the things that I stress in a lot of the charting events is simplicity. And we welcome your feedback, and we are attempting to provide very high quality continuing education using Sierra, because it really is a phenomenal program. And a lot of the people who didn't think they were ever going to use it because they were coming from TradeStation or some other place end up using it anyway. And they end up using it because it works off of our feed. It's fast. TOS had some issues today with data intermittently where everything was failing, and we were humming right along. And so that's a good example of it's just not a bad idea to use this, especially since it probably won't cost you any money if you're doing just a little bit of trading with us, in a 30-day cycle. So this is a chart here that I have that's called the Value Area Breach Project. It's a charting technique that I have been working on for, I don't know, a couple of years, maybe a year and a half, something like that. And basically, it's just what it started off as is a demonstration to people about how they can create their own filters or combine filters to make trading decisions based on a customized alert. And what it turned into was, wow, there actually might be some validity here. And then I started getting feedback from people, and a lot of my clients who were really, really good at the charts started giving me their own input. And I kind of came up with something that I feel is usable. And so what I'd like to do is I'd like to demonstrate just very briefly what this is. And then I'll show you a couple of examples, if we have some time, of how you could create something similar that jives with what you are doing. So this is not me telling you what to do. I'm not selling, nothing's for sale. So don't worry about having to give your credit card at the end of this presentation or anything like that. If you want the files to work off on your own, you're welcome to have them. But this is just to demonstrate, a combination of the capability of the program and possibly something that you find interesting. So when you look at this, we're looking at these several charts. So you have the S&P, the NASDAQ, the Dow, the Russell, and crude here. Okay, and some of these trades, you see these little flags here. These represent the trades we were just doing as I was demonstrating the activity on the dome. So I'm actually going to hide those by unchecking this show order fills option under the trade menu. So they're going to go off the screen there. So I just go to the trade menu. I just want to take those off to unclutter things for the moment. So let's look at the two charts where we see, actually we see on all three of these. So these basically represent sort of buy signals. And what the chart is doing is it's notifying me when a combination of two things are happening at the same time. All right, this one's a little easier to see. This dotted red line right here is what's called the value area low. All right, is anybody here familiar with the concept of volume profile or value area high, value area low, point of control? Anyone here heard those terms? Okay, if you have, say yes. If you haven't, say no, and that's okay. I just want to know how deeply I should explain them. Okay, yes, no, yes, no, yes, no. Okay, so let's just do a quick example. So this green line up here, this solid line that goes backward, this is where the value area high is right now. And this red line that goes backward here, this is where the value area low is right now. The dotted line is where it was at the time. So the reason why these values have converged is because the green line, the dotted line, represents where the value area high was, and the solid line is just painting the current value and then projecting that value backwards. So the reason why I have the dotted line here is so we can see where the value area was at the time that the signal came, not where it is now, because it's not as relevant. You know, we want to see what was going on at the time the signal arrived. The value area, which represents this area to this area, okay, all the area between the value area high and low, is where 70% of today's trading volume has taken place. So when you see the market above the value area, if you're talking to a market profile nerd, like a lot of our clients and a lot of our brokers, even in our office, they're going to call that it's above value. The market is above value. If the market's down here, it's below value. And the point of control, which is this blue dotted line, that is where that is the price at which the majority of the volume has traded in this session. And the argument that a lot of profile traders make is that these areas act like magnets, and there's usually a flurry of activity around the value area high and low, which I think is true. And a lot of times what you see is profile traders often trade reversion to the mean style strategies. So if the market is breaking and it's hovering around its value area low, they are looking for reasons for it to revert back to its point of control. And if it's going up above the value area high, they are looking for reasons for the market to go back underneath its value area high. So usually volume profile traders use this as a guide, and then they've got something else or a couple other things they might be looking for them to indicate momentum back in the other direction. So this is usually a reversion to the mean style strategy. Now, reversion to the mean style strategies are dangerous for people who don't have their head screwed on really, really tight. Why is that? That is because if you are buying the market when it's breaking, you have to have a point at which you are willing to say, you know what, I give up. If you are unable to do that, what you will end up doing one day is you will keep adding to your position as the market breaks until you blow out your account. That is eventually going to happen. It is virtually guaranteed that that will happen. So reversion to the mean style strategies are not for people who have a problem realizing a loss. If you feel very honestly that you have a problem getting yourself out of losers or you can't take a stop listening. All right, but let's move on here and talk about why, what is the second factor that I'm looking at. All right, now what you'll notice at the bottom of the screen here is we've got a CCI, and then I've got this measure of crude oil, which I actually am going to hide the measure of crude oil right now because it's becoming a little bit less of a factor as crude oil has broken over the last few days, being down approaching 70 and then coming back down, closer to 65. So I'm actually going to hide that just to get it off the screen for a second. And we're going to focus on the CCI. The signal comes when the market breaks down through the value area low, and at the same time, the CCI goes below negative 200. That's what a short or a long signal looks like. So what you often happen when you look at oscillators like CCI or MACD or stochastics or something like that, usually what you find is that they don't sustain extreme levels very long. Usually if the CCI goes below negative 200, it doesn't stay below 200 for very, very long. It doesn't necessarily mean that the market's going to rebound like it did in this case. Okay, but usually what you see is if the market is breaking this level, which is basically breaking a range that the market has held for all the time before that, and at the same time the CCI is flashing this extreme value, there is something going on. There is something going on. And traders are looking for, a lot of the time, they're looking for anomalous events or things that fall outside the bell curve. And this is one of those things. It's when the market is breaking above a range that it has been established throughout the day as a reasonable trading range. So something has changed, right? The market is saying, okay, you know what? There's a reason we should go lower. At the same time, there's an amount of momentum happening that is big enough to generate an extreme reading on the CCI. That's usually you will see a fast-moving chart at this time. The market will be flurrying around. So what this system does is it's going to show you an indicator that looks like a long indicator when the market does this at the same time. So this is being broken. At the same time, the CCI is negative. Same thing here. The market is going through the value area low. It goes all the way down. The CCI is hitting negative 200. This condition exists. All right, same thing with crude over here. So crude I've only really recently been starting to follow with this. All right, if we look back, we might see a sell signal somewhere. There actually have not really been a lot of sell signals. Here's been a couple of them. So maybe we can look back here. I'm on the Dow chart. Okay, so here's another example of a sell signal right up here. So notice that there's just the color differences. Okay, so the market goes up, 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 rips through this value area high. Okay, rips through it. At the same time, the CCI is above 200, very briefly it looks like, or just barely, but the sell signal arrives. All right, and that's an example of what this looks like. Now, is this a red light, green light system? No, it is subject to a very high degree of subjectivity. So it's not something you just follow blindly. Okay, here are some examples of how following something like this without proper context can get you in trouble. Some of this involves the other indexes themselves, and some of it involves other markets like crude oil or the yen and some other things, and that's the reason why they're being displayed here. One thing that you should watch out for with this type of a system is if all of the markets, all the indexes, forget crude for a sec, but if like the S&P, the NASDAQ, the Dow, the Russell are all showing buy signals at the same time, like the market is ripping downward through that value area low, the CCI is super negative, that is not a good long position to take. All right, if all four of the indexes agree that the you-know-what is hitting the fan and the market needs to go lower, don't go long. All right, it sounds like common sense, but it's kind of weird. It's counterproductive. It almost could be a short signal. If you see this happening across all four indexes with how out of whack they have been lately, then you could almost argue that if you see a buy signal on all four of these indexes, you could almost sell one of them and put a nice wide stop in and see if it just really breaks hard all day. All right, like the NASDAQ's up almost 0.75% today. The S&P is up 0.25%. The Dow's up 0.02%. The Russell's up less than 0.5%. The indexes have been really out of whack. Usually the best time you see these sorts of signals is when something it feels very muddled. There's no clear direction. The market is choppy, back, forth, back and forth, back and forth. Doesn't really know what it wants to do. That's when these signals tend to work the best. So if you see a buy signal and the other markets like aren't in agreement or they look really wishy-washy, that might be one you take. If you see a buy signal across all the indexes at the same time, all right, then you probably want to stand aside or maybe even sell one. All right, so that's just something to think about. Now, other things that you can use for confirmation or to stay out of the market's way. As you saw, had crude oil visible a moment ago. When I first started looking at the system, crude oil was down under $40. Okay, remember a couple of years ago when crude was really, really low and everybody was scared because it was starting to take down the stock market? It was a good example of how you can use another market to get yourself out of the potentially disastrous long. So what I had is I had the price of crude up here in a percentage format, and if crude really started to rip lower, it was taking the stock market down with it because all the energy company stocks were getting shredded. And that was an example of using another commodity that has a clear inverse relationship at the time with the market to keep yourself out of standing in front of a freight train. So I was watching crude oil to keep myself out of a potentially bad long in the stock market, because every time crude would take a dive, the stock market would go with it, and then we would end up seeing, a severely down, a downward move, and I'm trying to get long. So we were really trying to stay out of that. Now, another thing that you can use for confirmation, and you have to be judicious about this, the yen futures, are often have an inverse relationship to the stock market, but that relationship can come and go, very, very easily. So again, be judicious about using the yen as an indicator. Some people like to use the tick, which is the tick NYSE you see up here. So a lot of people will use the tick. How many people have ever heard the term tick fade? It's just a popular style of trading. It's been championed by a number of different educating people in the space. But a lot of people will use these extreme readings around 800 or 1,000 for the tick, because if the market reaches up there, it again usually doesn't sustain that kind of velocity. So if the market is rallying and the tick goes super, super high, and you see that short signal come up, that might be a good short, because this usually comes back down. It usually does not sustain that 1,000 level very high. So if you see the market ripping higher through that value area, the CCI is extreme. The tick is reading very very positive, but not all the indexes are flashing a short at the same time. That would be a good reason to sell one. All right, because you will see some degree of pullback. So another thing you can do to save yourself some money is, if you see the market break through the value area low and you get the signal, you don't have to necessarily buy it right at that moment. This is an imperfect system, right? Just like everything else, and it's not going to yield, these stop on a dime reversals usually. Usually the market will take some time. Like this one here, this looks like a painful degree of heat. It's really not. This is the Russell. You might have got into the market around 1683 or so. This is down here at less than maybe 1681. That's $100. I mean, that's not a lot of heat. If you're going to trade a system like this, you really should be prepared to risk at least a few $100s on a one lot. If that means you only have to trade a one lot instead of a two lot or a three lot, so be it. In the long run, you'll generate less fees. But it might be a little bit more boring. But if trading is exciting, you're probably doing it wrong, right? So with this type of a system, you need to be willing to take some pressure from time to time. This is a good example here. This kind of looks like a great long, right? But you might have gotten the signal up here, 25,300. This market's all the way down to 25,257 or so, right? That sounds like a lot of heat. It's not. 40 points in the Dow is only $200. So this should fall well within your risk parameters if you're going to trade a system like this. So the downside is, you get into a trade, you might be in it for a while. You have to kind of see what happens. But again, the objective is to give you a reason to stay patient, to trade less size, and be a little bit more selective about the entries. So again, it's to me, it's really impossible to get across all aspects in an hour of a relatively subjective system that looks like this. But it to me also is a good example of how you can let the chart do a lot of the heavy lifting and notify you when these things are happening. And the beauty of it is, like with this Russell, if I go into the studies section, you're going to see a lot of studies on here. A lot of them are replicants of each other, so don't worry too much about seeing all these lines. But you can actually hide a lot of this stuff. We really have the ability to hide a lot of the data. So if you don't need these daily open, high, low, close lines necessarily, if the volume profile that's kind of sitting in the background is distracting to you, you can hide this information. And the chart ends up looking more like this. So it's a beautiful application, because you can take the little bits, data points of each of the studies that actually matter to you, and you can have the chart display just the result of those things. There are situations where you might want to know, the trend of the CCI or something like that, but there might be situations, there might be those of you here who don't really care where the CCI is. You just want to know if the signal is true. So your chart might look something like this. You just have to be able to tell the program in a language it understands what the parameters are. And that takes a little bit of effort, but it also is something that someone like me, who is not a programmer, has the ability to do. All right, I'm going to do one example, not this complex, but just one example of how somebody could create something like this. So I'm just going to open up an S&P chart here real quick, and I'm just going to add the CCI, and let's do one quick example about how how I was able to arrive at. Excuse me. I'm going to add the commodity channel index, and I'm going to add the color background study. All right, so there's the CCI and the color background study. So the color background study is basically like a shell. We have to tell it what to do. All right, it doesn't know, it can't anticipate our needs. All right, the CCI, just add. My CCI has some custom settings on it. Nothing you couldn't do. I just made it 200 and negative 200 my defaults. You can put your own defaults in and check this box at the bottom that says save these settings as the default. So every time you add the CCI, it looks the same way. All right, and with the color background study, you basically have to be able to refer to the indicator's number, which in this case is ID number 1, as you can see up here, and each of its pieces has a subgraph. So the CCI itself is subgraph number 1. This line number 2, which as we can see here, is the 200. That's subgraph number 3. And then this line here, which is called line number 3, subgraph number 4, that is this line right here. So every indicator usually has a number of subgraphs. Some of them only have one. A moving average only has one. MACD might have a few, right? You've got the MACD, the slow line, you've got the differential line, and the zero line. So some studies have lots of subgraphs, and then some studies have only one subgraph, or some of them have none. But in this case, the CCI's got a few that we care about. All right, one of those is the CCI itself, and then the 200 line and the negative 200 line. Sometimes what I'll do, especially if it's one I haven't done, I'll open up Notepad and I'll just write, okay, ID1.SG1, which is how we're going to refer to the CCI. ID1.SG1, that's the CCI. ID1.SG3, that's the 200 line. And then ID1.SG4, excuse me, this should have been 3, right? Yeah, no one caught me on that. All right, ID1.SG3 is the 200 line, and then ID1.SG4 is the negative 200 line. So keeping this helps me, just jog my memory a bit when I'm actually writing the condition. All right, so as an example, if I just want to know when the CCI is above the 200 line, all right, here's how the code would look. All right, I pick a color. Let's say that the color is going to be red because this is going to be like my counter trend strategy. So my sell signal. So the way we're going to write this code, and again, I'll do this in Notepad, is you will say ID1.SG1, which is the CCI value, is greater than ID1.SG3, which is the 200 line. That's it. So the operators that you have to learn to use this properly are like greater than, less than, equal to, cross from above, cross from below, crossover. Basically it. There's really not much to it. So if I just put this code in here, like this, we are now getting a red line in the background every time the CCI is above 200. Then what I could do is I could duplicate that study like this. See, duplicate. Go to the settings and just change these around. So here's our initial code. So this is going to be like our short signal. And then for this one, we'll do ID1.SG1 is less than ID1.SG4. Long signal. Okay, SG4 is the negative 200 line, right? So I just take this code in here, stick it in the alert box, pick it, change the color to something else, and put it in place. And now we're going to get that blue notification every time the market is below negative 200. So very quickly, you could start to see how this is something that a regular person who's not a programmer by trade can start to implement. And it really, in my opinion, has a positive impact on decision fatigue, which is the idea that if you clutter your screen with a million different studies, times all the time frames you're looking at, times all the markets you're looking at, and all the stocks you're looking at, and all the newsletters you're reading, and all the videos, and all the, whatever, your decision-making ability is being eroded with every piece of information you process. All right, if you don't believe me, tough. I believe it to be a real thing, especially in trading. These negative aspects of your personality that negatively affect your ability to trade come out faster and more dangerously in this business than lots of other businesses. So it's really important to come to terms with your own weaknesses with respect to decision making, especially when you have something that you value at risk, like money. So what I would challenge everybody to do for, either the next event or maybe come to one of the events that I do on Mondays, start to think about the aspects of the studies that you find yourself feeling like you've got an edge. It might be 2 studies like mine. It might be 4 or 5 or 6. All right, now if you have 25 of them, you're probably never going to see a situation where all 25 of them line up perfectly enough to generate a signal, right? So don't, achieve a successful implementation of paralysis or analysis paralysis, because that easily can happen as well. But if there are a few things that you typically are looking for to line up, there's a good chance that we might be able to create a filter, and we will help you, that can notify you when those conditions are true. Not necessarily to reduce you to a signal following trader, but to get you to a decision point a little bit quicker. So when it comes to that intuitive part about making the trading decision, like, hey, all my long signals are firing, but guess what? It's 7:29 and 58 seconds and non-farm payroll is about to come out. I probably shouldn't buy this market, right? You still need to be able to think about it, but let's get you to that point just a little bit quicker than if you had to eyeball this thing across all the different markets and all the time frames you're following. So I really would, honestly speaking, challenge everybody here to start thinking a little bit about the elements of their strategy that get them to that decision-making point. And there's a good chance that we can help you put something together that will that can achieve a similar result as what you're seeing here, where you can be notified when those conditions are true. Some of it might not be doable without some real development or programming. Most of it usually can be. The program is quite flexible. So, that's really not intended to be a lecture. I really didn't mean it to come off that way, but it's all about my interest is in keeping the accounts around. That's just all there is to it. So everything that I share is going to be related to simplicity, the decision-making process, trying to keep people from over trading their accounts, trying to keep people from over leveraging their accounts. And over the years, I've found, certain ways of doing that. And one of those is to properly utilize the program that you are, getting here with us and designing it in a way that can help you build a strategy that doesn't require you to take, huge positions, or doesn't require you to take, 25 or 30 trades per day and still be worth your time. So hopefully enjoy it. I would welcome any final questions here before we wrap things up. I know we're 8 or 10 minutes over. Is there anything that anybody would like to ask, here before we wrap up for the day today? If you are, this would be a great time. And again, don't forget, if you would like access to the file, like if you would like this file, I'm going to put the studies back on. I will rename the file so with today's date, and I'll send it to anybody who wants it. All you have to do is send me an email, and I'll send it over to you. And my email address, for those of you who do not know, is just pz@infinityfutures.com, and I'll send that out to the whole audience here. So if you need me, just send me an email to that address. One thing I would ask is that if you have little groups of traders or trading buddies that you talk to, or if you're part of a larger group and you feel like the people in that outfit could benefit from this sort of attention, or someone who cares enough about the clients to do these types of presentations, I would certainly appreciate the referral. And I do lots of small group training for people, groups of 5 or 10 or 15 people. We can do something private in the evening or that sort of thing. We are willing to go the extra mile to keep everybody happy. So please do consider that. If you have someone who you might be interested in referring over to us, if you'd be so kind as to send them to me directly, that would be very much appreciated. And I thank you for your time. So I'll read some risk stuff here one more time. We'll wrap it up for the day, and we'll do another one of these in a few weeks. Don't forget that we are doing a weekly presentation on Mondays on the charts. That is a lot more focused on the mechanics of the charting program and less on, the bloviating, by me. So please feel free to attend those if you're interested in learning more about Sierra. All right. Okay, folks. Thanks again. Appreciate your time. I'm going to read some risk stuff here one more time, and then I will wrap it up, and we will see you next time. Thank you so much for coming to the presentation today, and we wish you the best. Thank you. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, everybody. Thank you again. See you next time.